Hello, and welcome back to the Central Arizona VITA Network's 2021 VITA Tax Law Training for VITA volunteers. In this session, we will finish our discussion of income and discuss adjustments to income. So here's where we left off. Right here is we're going to start talking about capital gains. Gene, take it away.
All right. Sale of stocks, you're going to need these 4 pieces of information whenever you go through a sale of stock. Next screen, because they can see this later. The thing we want to make sure you understand is your definition of short-term and long-term. A short-term sale of stock is taxed at regular income rates. And that means you've held the stock for 1 year or less. But if it's one day greater than 1 year, it's a long-term stock, and those are taxed at a lower rate than short-term. Then finally, inherited stocks are always considered as long-term, regardless of the date acquired or the date sold. Now, there are 4 kinds of sales that we're going to be reporting in TaxSlayer. Long-term with the basis reported to the IRS, and long-term with the basis not reported to the IRS. And short-term with the basis reported to IRS, and short-term with the basis not reported to IRS. So the problem here is the taxpayer, the client might come in and they bring a brokerage statement. And if the brokerage statement has just those 4 kinds in as subtotals within their brokerage statement, we can do that. Sometimes you will get a client who comes in with 5 or 6 brokerage statements. So they might have 10, 15, 20 different long-term or short-term sales that we have to enter. And the city of Phoenix has said it's out of scope for us if we have to do more than 10 of them. And that's great, because then we can concentrate on people who don't have stock income. The point here is most clients that I see, if they do have a brokerage statement, they might have a long-term and or a short-term sale to be reported. And it's easy to do. But all I have to remember is the sale of the stock in 2021 minus the cost of the stock, the basis, when it was bought. And does that become profit or loss? And if it's profit, it's taxed. And if it's loss, it could be carried forward. Go on, Jim. So here's a sample form 1099B, a brokerage statement. This is the part that I find personally the most difficult thing to see. All of the other tax forms that we deal with, a W-2, a 1099-R, a 1099 INT, those are all federal forms. They're set by the federal government through the IRS, and they're all the same for everybody in the country until you get to a brokerage statement. And a brokerage statement is prepared by the company that's selling the stock. And each company's brokerage statement looks a little bit different. And so you have to kind of hunt for the information. So I have highlighted on this screen some items. There's a short-term transaction for which basis is reported. We have the dates that they were acquired. So these were acquired back in 2017. And then the date they were disposed of, 2018. So these are all probably going to be short terms, right? They're less than a year. And then you have the proceeds, $652 in the first area. And then the cost was $534. So if the cost was less than what you sold them for, you made a profit. And that's finally over there under the gain section. But notice that the sample below it, that particular exchange, the proceeds were actually less than the cost, so you have a loss. So you have to enter these. And what I tell clients, I tell my new trainees to do is look for the subtotals rather than looking at the totals at the throughout the page, look for a subtotal where they've printed everything in bold, and they'll summarize all of the short-term transactions for which basis is reported, and that will all go on one line. And that's the information we enter into TaxSlayer. Okay, let's go to the next slide. So here's a TaxSlayer screenshot. It's actually 3 screens. The screen on the left is what you would run into at the top. You would just put in the description of the property, the date acquired, and then the date sold, and then the sales price. And then you'd be scrolling on down the page. Well, now we'd be in that middle column of select the cost basis type, the basis reported to the IRS, and then the cost that you had. If there were any adjustments that are listed on the form, you would plug those in. And so in this particular case, I plugged in a couple just to show you. There was, oh yeah, there was a wash. Okay. See that code there? The W, yeah, good, the W. So that helps. One more screen, Jim, so we get back to so that's where those would be input. It's just scrolling down the page, and as you scroll down the page, you enter all the information that you can find from the brokerage statement. Okay, let's go to the next slide. All right, under capital gains or losses, all belongings or property that you own is considered a capital asset. And this is true if the asset is used for personal use or investment purposes. If you sell the asset, the difference in the selling price and the purchase price is either a capital gain or a capital loss. Now, capital losses on personal property are not deductible. And if you have a net capital gain, that gain may be taxed at a different tax rate than your ordinary income tax rates. And normally, it's a lower tax rate. Next slide. If your capital losses exceed your capital gains, that amount of that excess loss can be claimed, but it's limited to $3,000. So if your net capital loss is more than this limit, you can carry the loss forward to later years. So I had a client come in and they had, I want to say they had a loss carry forward of like $18,000. Well, he can only take off $3,000 a year. So every year it's going to be diminishing or reducing by $3,000. But the only way to know that is if you see last year's tax return. So you're going to have to ask, and that's why we always ask our clients when they come to us at VITA, please bring your last year's tax return. We need to see it. Here's the income menu in TaxSlayer, and the capital gain and losses for Schedule D is circled. You click on Begin, and then that will take you to the next submenu. And you will have the top one is capital gains and loss items, where you would enter the information for your stock brokerage accounts, for the sale of the stocks, et cetera. But if you've got a capital loss carryover, you would click on that third menu and click there. And I think the next slide will show you what that menu then looks like. Here you've got boxes, and ones that I normally have dealt with have been the short-term loss carryover and the long-term loss carryover. And I simply put in 3,000. Now, eventually we'll get to a point where the client may come back and they'll say, well, I've got a loss carryover and whatever's left is $1,325. You'll put 1,325 in, and that'll end their loss carryover at that point. Okay, next slide. So here's an example. Zach bought 100 shares of Atoka for $3,000 back in 2007. In 2012, he bought another 100 shares for $3,300. And in 2021, he sold 100 shares for $4,000. But see, the problem is he didn't specify the specific block at the time of the sale. So we don't know which set of shares he sold. So the result of his sale of Atoka stock is, what would be your best guess? Gain of 1,000. Because our guess is at this point, we would go back and we would take the earliest purchase of shares, the one with the lowest cost or lowest basis amount. So the 4,000 minus the 3,000, the result is a long-term gain of 1,000. Next slide. Now, you will deal occasionally with sale of main home. That's an important sale. And I'm going to suggest right off the bat that this was a good example for the first time you do this, or the second time. Go ahead and check with your site coordinator. But in order to exclude to exclude the sale price, the gain you have on your sale of your main home, you have to pass two tests, the ownership test and a use test. And that occurs 5 years prior to the date of the sale. And so for those tests, you have to have, next slide, you have to have owned a home for at least 2 years out of the last 5. And you have to have lived in your home as your main home for at least 2 years of the last 5. If you have a gain from the sale of your main home, you may be able to exclude up to $250,000 of the gain if you're filing single. Married filing jointly, you could exclude up to $500,000. Now, if you bought the house for $300,000 and you sold it for $400,000, you have a gain of $100,000. If you can exclude all of the gain, you do not need to report the sale on your tax return, except in one condition. Next slide. If at the time you sell your house and you sit down with the escrow officer and you sign the papers and you get a form 1099-S, that means the escrow company has sent the details of the sale to the IRS and they're expecting you to report the sale. And so at that point, you're going to have to report the sale. If there's no 1099-S and it's excludable, you just pretend it didn't happen. Next tab. If you have gain that cannot be excluded, it is taxable, it's on Schedule D. And remember, you cannot deduct a loss from the sale of your main home. Emily sold her home in June of 2021. She recognized a gain from the sale. She married Jamie later in the year. Emily meets the ownership and use test. So which of the following is true? They, both Emily and Jamie, do not qualify to claim the gain as an exclusion, or Emily can exclude up to $250,000 on a separate or joint return. Emily and Jamie can exclude up to $500,000 if they file a joint return, or none of the above. What's your best guess today? There you go. Because Emily was the one who owned the home and sold the home. Jamie doesn't have anything to say about it, even though they might be filing a joint return at the end of the year because they're married filing jointly. But at the time, Jamie has nothing to do with it because he couldn't pass either of the tests. Next slide. Jennifer asked everybody, why would you get a 1099-S? I'm not really sure why. I just know that if your escrow agent includes a 1099-S, then you have a reporting obligation.
And just for your information, for those of you who have bought a house and you sit down at that signing and there's just stacks of papers and they're whipping through them, telling you sign here, sign here. One of those stacks of papers is a declaration of whether or not you've lived in the house for 2 years and owned it for more than 2 years. And if you sign that, they're not supposed to send you a 1099-S. Sometimes that gets lost in the mix because I have seen taxpayers show up with it. But it's kind of like Gene says, even if it was by mistake, they shouldn't have sent you one. They did, and they sent it to IRS. So you just claim it, and then on the Schedule D, there's a place in TaxSlayer where you can put a description. You claim the sale, and then you claim a loss on it to where it zeroes out.
Again,
that's what we do.
Yeah, that's why you would want to make sure you get your site coordinator involved so that the first couple times you go through this, you handle the sale accordingly. Now, for K1 earnings are reported as from partnerships or S corporations, some estates and trust. We don't do too much with K1 or earnings, except in certain things that are very limited. And so they are in scope. but most of the time when someone comes in with a K1 schedule, we look at it and go, whoo, that's too complicated. You need to go see a professional. Next slide. Interest income could be reported on a K1, dividend income, short-term capital gains and losses, tax-exempt interest income could be reported. Most of the time, what we see is royalty income. Somebody has mineral rights or oil rights, and they get $300 or $5,000 or $10,000 in a year from their royalty income. There's no expenses with that. So it's just a simple income statement. And so we can handle that on a K1 form. Next slide. Only when the source document is reported on a K1 or Form 1099 miscellaneous with no associated expenses. We do not do expenses. Even if the gain was more than $250, as long as there's no expenses, we're fine with it. David and Monica are both retired. They want to file a joint return. He has a 1099-R distribution from a pension for $32,500. Monica has a Social Security statement with $14,000 in box 5. Is Monica's Social Security income taxable? Now, to me, this is just a guess. I don't know where the cutoff point is. I just know that at some point in time, Monica's $14,000, some part of it may become taxable if there is enough other income available. So if David has $32,500, I'm always looking at the summary print page to tell me, was any of Monica's Social Security taxed? In this case, what do you think? Okay, yes, sounds good. But I couldn't really tell you exactly why or point they became taxable.
As I said, it's a complicated formula, and it's kind of a funny story. I had a client one time, both him and his wife were physicians. He was a surgeon, made a lot of money, and then he retired, and he just could not stand the fact that his Social Security was being taxed, because contrary to what I've kind of told you before, he'd already paid taxes on those Social Security contributions. The only reason it's being taxed is they're trying to save it from going broke, right? And he just hated that. He made me go through that whole worksheet. And I'm telling you, it'll give you a headache going through it, because it starts off with one threshold that if they exceed a threshold, then 50% of the Social Security is taxable. But as they increase more and more, then more and more of a percentage becomes taxable, up to a maximum of 85%. And you get to that 85% pretty quick. You know, I told you earlier, you know, that my wife's Social Security, we pay tax on 85% of it. Believe me, I'm not as wealthy as he was. So, you know, I get a pension and a little bit of Schedule C earnings, but it maxes it out right away.
The thing you want to kind of be aware of is that a client could come in, as one did a couple summers ago, an elderly gentleman, probably in his 80s, and he had Social Security income. And that was his only source of income. And it was like, I want to say, you know, around 20,000. But he had decided that he wanted to take all of his IRA and take the total distribution. He wasn't going to take a monthly payment anymore. He was going to close out the whole thing. So he took a full distribution from his IRA in the amount of somewhere around $80,000 or $90,000. Well, that all became income. And so that year, his Social Security was taxed at about, I don't know how much it was taxed, but he was shocked that his Social Security was taxed. And then he was more shocked when I sat down and said to him, the bottom line is you owe $11,000, because he hadn't had any money taken out of any withholding from his total distribution. So he had to pay tax on it. That is a real shock to clients at times. They've made a financial decision, and then they find out later in the year when they're filing their taxes And his comment to me was, well, I don't have that money. What do I do? There's a section in your 4012 at the back. I thought, oh, I think it might be tab N or tab P, something like that. It's near the back of it, but it talks about things that you can do, that you can share with a client about what to do if they're having trouble paying their tax owed. Next slide.
Hang on, I was just responding to a
Oh, okay.
thing. Good.
Okay, any questions about capital income?
And I was just responding to Mary Ellen. I'll quit typing because I can talk a lot faster than I type. Mary Ellen says, suppose the gain was more than 250,000, but you did not get a 1099-S. The excess gain is still reportable, right? And the answer is yes, assuming she's single. I mean, if she's married, then it's 500,000. But yes, whether you get the 1099-S or not, if they tell you they sold their home, and then you want to ask them some questions about it. And the basic simple questions: what did you sell it for? What did you buy it for? Did you live in it for 2 years of the last 5? Did you own it for 2 of the last 5 years? And then if the gain didn't exclude it, don't worry about it. But if they say, yeah, I sold it for $1 million, I bought it for 100,000, 20 years ago, and yeah, we've lived in it ever since and owned it, I didn't get a 1099. Well, we need to report it.
You've caused me to think of another story.
Yeah, go ahead.
We had an elderly woman come into an ARP site whose husband had died 4 or 5 years earlier. And she had sold her house during the year and moved into another house. And we came up with about $400,000 of gain, but her filing status was single. And so we spent a long time going over, is there anything that you have done in your house that we could use to lower the basis or lower the cost of that house, so that we don't have so much gain to report as tax. And if you've got things like you put in new windows, you had the house painted, things that you would do to spruce up your house or to maintain your house, those all can help lower that gain because of their expenses. But that's a case where I kind of felt like she needed to have sold that house within the year of his death, because they could have claimed the total gain as married filing jointly. But by letting it slip a couple of years, she became single, and all of a sudden her exclusion amount is a smaller amount.
But I wish I would have been there, because I'm going to throw in a wrench here that it comes with years of experience, but this is good for folks to kind of realize, because at least maybe even in your personal life, there is something that at death, when you inherit an asset, you get what's called a step up in basis.
Right.
And remember what we said, the basis is the cost that we use. Well, in this case, when her husband died, and this gets a little tricky, because the house had to be titled a certain way. It had to be titled joint survivor with right of survivorship, jointly titled with right of survivorship. And if that's the case, when her husband died, then the basis gets stepped up to the fair market value of dated death. Now, that's a complicated thing, but the reason I just tell that story is because I ran into that last year at Via Linda. Same thing, and it was okay. I'm not sure if that story that Gene was just saying, it may or may not have been okay, because it depends on what the value was at his date of death. But that would have been another way to get it. Or as he said, and you should always do this with the sale of any capital asset. If you have a capital asset, let's say you have a share of stock that's not in a brokerage account. You own a share of Microsoft, and you tell Microsoft, reinvest my dividends. And every year they're going to send you a statement, and you're going to pay tax on the dividends, but what they did is bought more stock with it. So now when you sell that stock of Microsoft, you have more basis because all of those dividends that you bought more stock with increased your cost in that. I know that gets a little complicated, but it's just something that you should start absorbing now. So, and I'll stop right there. Okay.
But that's a good example.
Yeah.
Let's go on to the next screen.
You bet. Whoops. Hold on.
Okay, we talked earlier about the W-2G unemployment federal form, and Jim had mentioned that Arizona doesn't use that form. They'll mail out a copy to the person who's taking unemployment compensation, and this is the type of form that they will bring to us at a VITA site. And you have to remember to use the state ID number and federal ID number at the bottom of the form, not at the top of the form. And it looks like a letter. And so it's something that the state of Arizona does that a lot of other states, well, I shouldn't say a lot, but there's some other states who do the same thing, but most states use the federal W-2G form. So the taxpayer can't tell the difference. As long as you put in the software, you put the unemployment compensation in that yellow box in the middle, along with the federal income tax withheld, it'll calculate it correctly. Okay, next slide for unemployment. Oh, well, here's the screenshot. So again, it just, you enter the information right down the page. And unemployment compensation, the federal tax withheld, the state ID number, and you click continue at the bottom of the screen. It saves it and moves on to the next item. For example, Colton was laid off. He received state unemployment compensation totaling $4,000. How much would he report as income? Now, last year they excluded $10,200, but this year there is no exclusion. If you get unemployment compensation, it's income. Next slide. Dealing with alimony. And we have to talk now in terms of 2019. Anything occurring before 2019, alimony was taxable income. And anything before 2019, alimony was an adjustment to income for the payer. So whoever was paying alimony could actually reduce their gross income by the amount of alimony they paid. And anybody who received alimony would have to add the alimony to their gross income if it occurred before 2019. And then we made a change. Next slide. You would put that amount in TaxSlayer. It's a real simple amount. Boop, 2 boxes, and you hit continue, and then you're moving on. You need to put in the recipient's social security number if you've got that. And I think the next slide will show you. Okay, I was wrong. Now, after 2019, that's all right, go ahead. We'll get to it in a couple more slides. For 2019 and beyond, alimony is no longer taxable income. We don't even count it. We don't put it any place. And alimony for 2019 and beyond is not an adjustment to income. In other words, the person who comes into us and says, I'm paying alimony, and it occurred and they had their divorce in 2019 or 2020, we don't care. It's not reported. It's not put in. But if it occurred prior to 2019, yes, we have to deal with it. That's the big change in how alimony is taken care of. Let's go to the next slide.
If I may interject here, just you may ask, well, why did they change all of these rules? And prior to 2019, the lawyers in a divorce, especially if there were wealthier people, you could actually structure it to be either way. Either the payor gets the deduction, or the payee has to claim it, or vice versa. The payor doesn't take a deduction and the payee doesn't claim it. But usually what you would do to structure it is you want the wealthier person, usually he or she is the one paying the alimony, they get the deduction, and the person receiving it is usually the one who makes less income. They put it in income. And so the government was losing out on tax dollars. And the Tax Cut and Jobs Act, one of the ways they paid for the tax cuts is they said, no, we're not going to allow that anymore. That's, you get no deduction when you pay it, and you don't have to pay income on it when you do it. And that way it boosted revenue for the government.
And Jim just talked about
Oh,
that.
sorry.
That's all right. So this is a slide that Jim talked about. And there's the next one, results of the increased tax burden. You cannot deduct alimony or separate maintenance payments made under a divorce or separation agreement executed after 2018, or if they were executed before 2019, but later modified. If you got divorced in 2018 and you had alimony set up, or 2015 or 2010, and you had alimony and separate maintenance payments set up, but then in 2020, you modified it. When you modify the divorce agreement, you're now under the new rules for divorce. And that gets rid of alimony payments and separation maintenance payments for tax purposes. So we might see a client come in with a divorce that occurred in the last 4 or 5 years, and they've decided to make some modification to it. We have to be aware that that modification now puts them under the 2019, 2020, 2021 divorce rules. Next slide.
So can I just clarify? So what you're saying is if the divorce occurred before the end of 2018 and there was an order for alimony, then that alimony is either taxable or deductible. But if it was, the divorce decree was issued after 2018, then it wouldn't be?
Correct.
Okay.
And if the divorce decree is modified in 2021, then the new rules apply.
Then the new rules apply to it. So if someone comes in and they were divorced before the end of 2018, we do have to account for any alimony. And
Right.
I think child support is the same.
Yeah. Child support is not related to alimony and is not reportable as income. So let's just deal with the divorce and alimony payments. I was trying to think, there's something else. Oh, on this screen that you're seeing right now, it says instruments executed after 1984. If you get a really old person, like me, someone that might have gotten divorced back prior to 1984, or excuse me, prior to 1985, we can't do their taxes, because the way divorce was handled and alimony payments, et cetera, was handled prior to 1985. The federal government changed how that was handled. And so VITA sites simply say, if you got divorced a long time ago, prior to 1985, we can't even handle it. You'll need to see a professional. Let's go on to the next slide. Child support is not taxable, nor is it deductible by the taxpayer. Child support is not the same as alimony payments. Moving on. So Tom separated from his wife, but he does not have a legal separation agreement. He's paid $3,000 during the tax year for the support of his son who lives with his wife. So which of these statements is true? Child support is an adjustment to income? Well, not after that last screen. The entire $3,000 may be considered alimony and an adjustment to income? Not after that last screen. Must be C. Next screen. Under income, we have less common income. This was the menu when you get to, in TaxSlayer, when you get to income, less common income is at the bottom of the first menu page. And when you click on less common income, then you get this stuff. And that's where you enter gambling winnings and K1 earnings. Luckily, most of this stuff is out of scope for us. But I want to point out that the first title, Other Income Not Reported Elsewhere, I think the next screen will show that screen. No, it doesn't. Go back. Other income not reported elsewhere will give you a block to write in a description, like painted my neighbor's fence, and then another block to put in the amount, $400. Under that third title, Other Compensation, if you click there, it will give you some specific ones, and that's where we tend to find, I think it's the first or second item, it lists scholarship income, where the scholarship exceeds the qualified expenses, and so it's taxed as unearned income. And that's where it will appear in that Other Compensation submenu. Okay, let's go on. Any questions so far? Should we take a look at what's in chat, see if there's anything to do there?
Yeah, I think I've answered everything in the chat.
Okay.
Somebody had asked about so that he said the 2019 cutoff is for the date of divorce. And I kind of clarified that it's either the date of divorce, the date of the agreement, the divorce agreement, or the date of the modification. You got to be careful.
Yeah.
And why would it be modified? Well, some people who are getting alimony, they go back to court and say, he's making double what, and it's because I supported him all through his med school, or whatever. And they get the court to increase their alimony or something like that. So. Okay,
now we're getting to adjustments to income. So the adjustments are what is subtracted from your gross income. So on your 1040 form, I think it's lines like 7 through 11 or 7 through 12, something like that. We have all these income statements: income from wages, income from interest, income from deductions, income from sale of stocks. But we're now at the point where we want to take a look at some adjustments that can be subtracted from that income, which will give us the adjusted gross income line. So these are the things that are adjustments. Educator expenses, you will see a lot of. Student loan interest deduction, you will see a lot of. And there's a couple there that require military certification. They're in scope for VITA if you've got military certified people at your site. That takes at least 2, one to prepare and one to do the QR. However, for the city of Phoenix, almost all of the time, we send them over to the site closest to Luke Air Force Base. And the site coordinator works with her volunteers to make sure they're all military certified. I found out this past, I guess it was this year, maybe it was a year before, with COVID, I worked a few times over at Turn a New Leaf on the west side of town. And there, the coordinator for the program, all of her site coordinators have military certification. But that means sometimes at a site, that site coordinator is the only one that has the military certification, so they can prepare it, but then they have to call one of the other site coordinators to come over and do the QR on it. So, but that is the process for, you do a return, you have somebody else do the QR. So educator expenses and student loan interest deductions are the 2 that are most commonly used. Next slide. Taxpayer identification number. Okay.
Can you explain why the tuition and whatever thing was crossed off?
Because Congress did away with it.
So it was still on the practice lab last night.
Well, yeah, but practice labs being updated today and tomorrow and the next day. That's why we don't have Arizona. This is the month of December, and TaxSlayer's practice lab is going to be updated every day. You can't do an Arizona return right now because Arizona is not in the 2021 TaxSlayer. If we
So where would the tuition for Chandler, Washington be put now?
It will be related to an education credit.
Okay.
Beth, just to be clear, tuition and fees deduction is not an adjustment anymore. They took it away as of 2021.
That's confusing when you have a lab. Didn't we have to use it for Chandler last night?
No,
Well, then I did it wrong.
Okay, well,
That's
go
okay.
back and fix it. That's okay.
practice lab.
And when we get into credits tomorrow, I think you'll probably find out that, and the year before, you can take a choice. Yeah, I could take a tuition and fees deduction, or maybe I can take a credit. And usually you're going to find out the credit is the way better place to take it. And we'll see that tomorrow. Okay.
And this is the reason why for the last 3 or 4 years, when I've been teaching these classes, I've always asked teach in January, because by January, the second week in January, when we start teaching these classes, TaxSlayer has been updated. But last year with COVID and all the regulations that were passed, remember Congress passed an act prior to Christmas of 2020, I believe. And President Trump didn't sign it until the week between Christmas and New Year's. And it went into effect and affected taxpayers the end of January. And the IRS hadn't even had a chance to revise the rules to fit that new federal law. And TaxSlayer, as its contractor, had not even had a chance to put that into the software coding. So we had people, we were making changes as we taught the class in January, day by day. I was redoing slides. So this slide, when I came across it, I thought, rather than try and figure out when I can take a screenshot of the adjustments for TaxSlayer, I'll just put a do not use sign. When you go into TaxSlayer Practice Lab now in the month of December, you will find things that don't work because they're being changed. I was doing a return last night for ARP to get the information put in. One of the things that we talk about is child tax credit, which is coming up in the next session. And the child tax credit, when I started to put it in, the computer just spins and spins and spins because it's not fixed yet. It's not the way that TaxSlayer wants it to work. So you have to back out of it. So if you're, for the case of scenarios 7, 8, and 9, if you run across something dealing with a 1098 tuition or education expenses, that option to do tuition and fees deduction isn't going to be there. It might still be in the practice lab, but that's from last year and it's disappearing. So you need to go to the education credits. You need a taxpayer identification number for the person who received the alimony. And if you don't enter that, you could result in a disallowance of the adjustment and a penalty. This is for prior to 2019. And I think the next screen will show us that child support is not blah, blah, blah. Go ahead, keep on going. Alimony is still considered as income and expenses as long as the divorce or separation instrument was executed by December 31st, 2018. So there's always going to be these cutoff dates, and normally they are the December 31st of whatever year is the cutoff. So that's where the breaking point is. Starting January 1st, 2019, alimony was treated a different way. Next screen. So if you run into that case where you don't have the ex-spouse's social security number, you can enter this number 00011 and then zeros. And that will allow the TaxSlayer software to go ahead and complete the return, but it becomes a paper file. It can't be electronically filed. Next screen. If the taxpayer has the ex-spouse's social security, you enter it and put in the amount paid. If you don't have it, you put in the zeros with the 11 in the center, and then it becomes a paper file. Last year, I didn't have, well, of course, last year was a strange year anyway. I have not had anybody come in with where I've had to do this. Most people who come in who've been divorced, and I would say 95, 98% of them, if they have a divorce, they come in with their divorce decree. They have all the information necessary for filling out the taxes. I think probably the only time you might run into a problem would be someone who just recently had a divorce. and has not filed taxes yet. But most of them, they have all the forms necessary. They've got all the information. They know how to handle it. Matter of fact, the first one that I ever dealt with, the client taught me how to deal with it. Next slide. Educator expenses. As long as you have worked more than 900 hours during a school year, you can deduct up to $250 if you're filing single, or $500 if it's married filing jointly, if both are K-12 educators. K through 12 means kindergarten through high school seniors. And it can be an instructor, a counselor, a principal, an aide, but it has to be 900 hours. Some aides are hired part-time, and if they don't make the 900 hours, then they can't take the credit. I mean, the adjustment.
Hint, hint, you're going to see this in your test booklet too.
Oh, good hint. Next screen. And here's all you would input. There's just 2 blocks, whichever person it is. Here, this was limited to 250. And in this particular case, Cindy Young used 138. You could put in, like, say they tell you they spent $700. You could put 700 in that box, and software is going to limit it to 250. Here's that penalty on early withdrawal that we showed a while ago. That becomes an adjustment to income. You don't have to worry about where to put it. It's just when you fill out the 1099 INT form, when you put that information into box 2, the software will move it over as an adjustment to income and make it a subtraction from the gross income. Moving on.
And I think this, if I remember right, this is in one of the tax returns that you've got to do too. So just, and you know what? Tax Slayer handles it perfectly, but if you see it, key it.
There you go. Student loan interest deduction is another one that we see fairly often, and this is the standard federal 1098E form. They all look exactly the same. There's one box, box 1, student loan interest received, and that's what we're going to key in. That's it. Let's go to the next slide. I think
Yeah,
that's the
I'm going to point something out here too. As a person who has student loans and does this to the last year and a half since COVID, they have suspended. Well, you know what? I say that, and now I'm going to backtrack a little bit. On federal government student loans, they suspended the interest. So I won't get one of these. I haven't paid any interest on it, but you know, there are other student loans from private banks. Yeah. And I'm not sure if that suspension applied to those or not. But my whole point is we may not see many of these this year.
So the maximum deduction is whatever is 250, smaller of 2,500 or the actual interest. So if their student loan interest is 3,500, they're only going to get to take 2,500 as an adjustment. If their student loan interest was $700, they only get to take the 700. They don't get to take anything extra. They have to have an eligible educational institution, and there are AG limits, but you know, they're so high, most of our clients don't meet them. So I don't really worry about them too much. And it's a simple one item box that goes in, and then you hit continue and you move on. Charitable contributions. Single filers can deduct $300 in charitable cash contributions as above the line on a federal return. Married filing jointly can now deduct $600. Last year, the limit was $300 per tax return. This year, they've made it $300 per person on a married filing jointly. Remember, when we say above the line, what we're talking about is the line is adjusted gross income, and an adjustment is above the adjusted gross income line. That's why you'll sometimes hear them say, oh, this was an above the line figure. Okay, that tells you it's income minus adjustments, and that gives you the adjusted gross income. Next slide.
And if you'll allow me to expand on this just a little bit, we're going to find out in the next session when we talk about the standard deduction versus itemized deductions. And I explained yesterday Charitable contributions is one of those where you would itemize deductions. And generally, if you take the standard deduction, well, you know, it was kind of like those gambling losses I was saying, right? You wouldn't get to use them if you're taking the standard deduction. This is different. This gives you an addition to the standard deduction. So even if you're taking the standard deduction, you can claim up to this 300 or 600 married filing jointly in addition to the standard deduction.
Okay, HSA contributions, health savings accounts. This is also an adjustment to income. And we're going to spend a little more time on a health savings accounts because this is becoming a more popular medical insurance financial payment system. These are the limits for the year, and they're adjusted for or they're indexed for inflation. So next year there'll be a different number. Next screen. Next screen. In terms of growth, the growth has been between 7 and 13% every year since the HSAs were introduced. So I'm expecting that we're way above 26 million Americans who now have health savings accounts. More and more of our clients are going to come to us with a health savings account. It's a tax-favored medical savings account. It's available to taxpayers. It enables taxpayers to pay for your medical expenses and save for future qualified medical expenses on a tax-free basis. And that's the key. If you put money into an HSA, you can invest it for added growth so that by the time you retire, you will have a pile of money allocated to healthcare expenses. You also have the option to withdraw funds at any time to pay for medical bills. The money you put into your HSA is income the IRS cannot tax you on. You have to have a high deductible health insurance plan in order to have a health savings account, a high deductible health insurance plan.
And, you know, I don't remember the exact amounts of it, but it differs between whether you're single or whether you've got a family plan. And we're finding a lot of employers. My wife's employer was St. Vincent de Paul. And what they did is they moved to a high deductible plan. And when it says high deductible, I'm thinking it's like $1,200 or $1,500 for an individual and $25,000 or $3,000 for a family. In other words, it's up there. You know, those are the expenses you got to pay out of pocket before you get any insurance coverage. But then what they do is the employer contributes money to your health savings account, and then or they match what you put into it too. So it's your money, and then it's kind of like the 401k style of it. So.
An HSA is owned by an individual, but contributions can be made by any other person. Your grandma can make a contribution to your HSA, your aunt, your uncle, one of your friends at work. And the amounts can be accumulated over the years, or they're distributed on a tax-free basis to pay for or reimburse qualified medical expenses. Next slide. Now, there are 3 forms. There's the intake and interview form, has a question on it about HSA contributions. Then there are 2 forms, government issued forms, the 5498 SA and the 1099 SA. It's used to report contributions and distributions. Our clients, some of them will bring the 2 forms from the IRS. Sometimes they don't, but on the intake interview form, they might mark down that they had made some contributions. And then there's one other way we'll know that they have an HSA, and we'll get to that in just a second. Next slide. So there's the intake interview form. Have a health savings account? Bum, bum, bum. And notice at the end there, it says W-2 with code W in box 12. If you see a person's W-2 from their employer telling you what they made for what they earned for the year, and under box 12, they have a code W, they had an HSA, And the employer put that amount of money into the HSA. Woo-hoo. Okay. There's box 12. That's where you might see the code W. Next slide. Here is a 1099 SA. This is the form for distributions. There will be something in box 1. There'll be a code. Normally it's 1. And on the back, there's some other codes, but normally it's 1. And then there's an X in the box. Oh, look at that. There's a white X there. Huh. There's normally a X box in the HSA. Now, if there's a check mark under the Archer or the MA, they're out of scope. And we'll cover that as an out of scope item in a few minutes. Moving on. Here's the form for contributions made. And again, there will be box 6 has the box marked for HSA. You might have in box 4 rollover contributions. I haven't seen one yet, but as more and more people are using this, I have a feeling we're going to see that. Next slide. These other 4 items are all out of scope. Archer Medical, Medicare Advantage, health reimbursement, flexible spending. These are all types of savings accounts for medical reasons, but they're all out of scope. We only deal with health savings accounts.
And sometimes I found in the interview, I'll see them mark that box about an HSA, but I said, well, didn't you get any? I don't see anything on their W-2 marked. And I said, well, did you get any of those other forms, the 5498 or the SA 1099? And then as I get to talking with them, it really comes out, well, yeah, no, my employer just reimburses me. Oh, so you had a flexible spending arrangement or a health reimbursement. Oh, yeah, okay, I guess that's what it is. So sometimes you got to ask questions about it.
And that's normally the case for a person who's just starting out with an HSA. The people who've had them for a few years now, when they come in, they've got the forms or they've got the statements from their HSA provider. So in order to set up an HSA, you just have to work with a trustee. It could be a bank, an insurance company, anybody that's already approved by the IRS. Our federal credit unions have HSAs. Banks have HSAs. So and also there are certain large employers have set up HSAs. They've been set up and approved by the IRS to be a trustee. But it's something that I guess what I'm after is sometimes a client will say to us, do you recommend or can you recommend an HSA? Or sometimes a client will say, can you recommend somebody that I go see to get my ITIN application approved? We don't recommend, is what I'm getting to. We can't make recommendations. That means that we're trying to endorse a particular person or product. So we don't make the recommendation. We just tell them, you can go look that up online. There's plenty of them out there. Next slide. Oh, that's pretty simple. Yep. Next slide. The benefits, the interest and other earnings in the account are tax-free. The distributions are tax-free. There's no deadline, and the HSA is portable. In other words, you can move jobs from job to job to job, and the HSA goes with you. Okay, next screen. You have to be covered by a high deductible health plan on the first day of the month. You cannot be covered by any other health insurance. You cannot be enrolled in Medicare. You cannot be claimed as a dependent on someone else's tax return. Moving on. Married couples cannot have a joint HSA. There is none. There is either a self HSA or a family plan HSA. However, Congress kind of changed things and fudged a little bit and said, you can use your self-only HSA to cover your spouse's expense or from your family for your spouse. Now, in the event of the death, the HSA will be treated as the surviving spouse's HSA only if the spouse is designated a beneficiary. Any individual can contribute. An employer's HSA, the employer, or both may contribute. So for an HSA established by a self-employed individual, the individual can contribute. To anybody, there's a lot of ways you can get money into an HSA. Moving on. Have to be made in cash. We're not taking stock or property. Moving on. Now, employer contributions are allowed to be made as an employee's HSA. Generally, employer contributions are excluded from an employee's income. Employer contributions are reported on Form W-2, Box 12, using Code W. We've seen that already, but we're saying it again. Moving on. Here's the limits once again. Moving on. Taxpayers must reduce the amount that they can contribute by the amount of any contributions made by the taxpayer's employer that were excluded from income. Next screen will show you an example of that. So if the annual contribution limit was $3,650 and your employer contributed $1,000 to it, that means you can only contribute $2,650. And it's 12 o'clock. The clock is chiming. I guess we better call a break now. Let's come back after lunch and pick up here with the last month rule.
Yeah, good idea. I would like to answer one question that Mary Ellen had posed. She said, is the entire tax return is out of scope with other medical reimbursement arrangements? And I'm going to say not necessarily, okay? Because if it's an Archer MSA or that, which I've seen very few of them, where we have to do some kind of tax calculations, then yes, the entire return's out of scope. But if they have a flexible spending account, it had no effect on their tax return at all. Or even a health reimbursement arrangement. We don't have to file any forms with the tax return. So it's not out of scope. It's just that, well, we don't really do anything. But if it generates a form and some kind of tax liability or tax credit because of the Archer MSA or something like that, then yes, it's out of scope. So I would tell you, when you see one of those, you got a question, ask the site coordinator.
Okay, let's take a lunch break and come back in an hour.